And good morning, all you wonderful melonheads. I hope you guys are well. Today is Tuesday, April 18th, 2023. And the big story going on right now, you put on the traditional finance press, you're going to see about bank earnings. You're going to see Goldman posted a big miss because of their investment banking division. Bank of America posted an earnings beat because of net interest margin, right? They're all talking about the same story about the big bank earnings. But we'll talk about them for a little bit today. But the big stories going on, or the little stories, I should say, is what you need to be watching. Because there's two stories that I found this morning when I woke up and went digging. And shout out to my moderator, Mish, who helped me find some of these just before we went live. These are important stories. It affects the auto market and it affects the commercial real estate market. Right. The first one, U.S. auto sales just announced that they're closing their doors temporarily, of course. They're closing all 50 of their dealerships nationwide. This is a subprime auto lender. They specialize in selling cars to risky buyers, and they do all their financing in-house or through their sister companies. Basically, banks are tightening up the lending in the auto market, and it's starting to kill the most vulnerable dealerships first. This is the second such story we've seen in a couple of weeks. We also saw American Car Center went down a couple of weeks ago after failing to issue a $220 million bond backed by loans to the auto market. The debt market has no appetite for overpriced, risky auto debt right now, and companies are starting to fail because of that. And like we saw with the housing crisis, first it affects the subprime. First it affects the riskiest borrowers. It doesn't stop there. It cascades up the chain, eventually driving up borrowing costs and pricing out even less risky buyers. So that's going on in the auto market. Also today, we had Brookfield Corp. You may recall them from defaulting on two very large towers in Los Angeles about a month ago, the 777 Tower and the gas company tower. Well, yesterday, Brookfield defaulted on another $161 million worth of commercial real estate loans, this time backed by more than a dozen buildings in and around Washington, D.C. So we've got more defaults in commercial real estate, more trouble in subprime auto lending. These are the big warnings that are going off in our economy. And these are the kind of things when everybody's going to say, who could have seen this coming after all the mayhem starts in finance? And look, I get this all the time, Jack. It's just more doom and more gloom. And, you're a perma bear. Yeah, I get it. I own that. I wear it right here, perma bear. But, folks, these are the warning signs being shown to us. These are the alarms going off in the economy. Traditional finance press is not going to cover it. They're only going to talk about J&J earnings beat by a couple of cents and the stock is up. And, of course, the stock market is higher this morning, marginally so. With that, let's shrink my big melon of a head and let's see what's going on in stocks. And there we go. The S&P is up 13 points right now at 4,164, up about a third of 1%. The Dow is actually down 70 points right now, or 0.21%. Now, the second largest weighting in the Dow is Goldman Sachs. Goldman did not post a good quarter right now, so I suspect Goldman is the sole reason why the Dow is down, even though the other indexes, the S&P and the NASDAQ, are up. Speaking of the NASDAQ is up 60 points right now, or about a half of 1% at 12,219. Elsewhere, the DXY, the dollar's down about 22 basis points right now at 101.88. Still right around the neckline of that big head and shoulders pattern I've been talking about for a while now. Still not sure which way that one's going to break. Is it going to break down on a weaker dollar as the world continues to de-dollarize and the yen continues to strengthen over in Japan, anticipating that big move from the Bank of Japan? Something I've been talking about on this channel for a while. Or are we going to see the dollar rocket higher off of some kind of global deflationary event that causes a scramble for dollars and a shortage of dollars, which sends the Dixie much higher? Honestly, I don't know which way that breaks. It could go either way. We're at one of those inflection points in the market. Looking over at the bond market right now, we've got yields are largely higher across the curve. We've got the 10-year is at 3.59, up not even 1 basis point. Basically no movement going on the long end of the curve right now. Over on the short end, we've got a little bit more. The 3-month is up about 8 basis points. The 6-month is about flat. So not a whole lot happening in bonds this morning. Looking over at precious metals, we've got gold is down a couple of cents, still clinging to that 2,000 mark. It sold off pretty hard at the open yesterday, bounced just below 2,000 and then stayed there just above 2,000 for the rest of the day yesterday. Silver, pretty much the same thing. We saw a big sell-off at the open yesterday. Came down just below $25, bounced just above and stayed there, trading right around that level right now at about $25.06, down about 3 cents today. Crude oil is at $80.68, down about 15 cents or 0.2% this morning. And natural gas is at $2.30, up about 3 cents or 1.2%. All right, but here is the story right now. Shout out to Car Dealership Guy on Twitter. This is a pretty good feed. I've been following him for a couple of months now. He's done pretty good. He recently started a YouTube channel also. If you want to stay in touch with what's going on in the auto market, and look, transportation is about 15% of the average household's budget. So this is a good one to keep track of. You want to know what's going on in the auto market. Major news in subprime. U.S. auto sales has temporarily closed all operations. Ally dropped their floor plan and inventory line of credit. That's unconfirmed. Major subprime dealer group with nearly 50 locations, and the CEO's LinkedIn has been deactivated. Yikes, that's not a good sign. And up here, there's a message from the CEO to the company. Dear U.S. Auto team, I regret to inform you that effective immediately for the next 48 hours, temporarily of course, we must temporarily close all of our dealership locations and temporarily pause our retail operations, including our BDC, underwriting, and reconditioning. If you're currently working in one of these areas, please finish what you're doing, clock out, and leave the facility. Yikes. Managers should stay on site today and continue to report to work over the coming days. Yet managers who were not paying by the hour, you guys still have to come in. All the hourly employees, get out of here. Our loan servicing operations will remain open and continue to support our customers. Members of our corporate team will continue to support our operation in a limited fashion. We're continuing to work with internal and external stakeholders to arrive at a solution that allows us to reopen our dealership locations. Your direct supervisor or manager will reach out to you later today with further information. Sincerely, Bob Anderson, Chief Executive Officer of U.S. Auto Sales. So I had never heard of this company before today. I don't live in the auto space very often, so I wasn't too familiar with them. I went to their About Me page this morning, and there's a little bit of Q&A, and this gave me a little bit of a clue of what's going on here. What is in-house financing? This is on U.S. Auto Sales website, and how is it different from a bank or other lending? As a dealer that provides in-house financing, more commonly known as buy here, pay here dealership, we act as both the car dealer and the lender. This means we offer financing for the vehicle you purchase from us, and our related company will service the contract through its completion. This allows us to specialize in approvals for buyers who would typically get turned down, aka subprime, at other dealerships, giving buyers an opportunity to finance a vehicle and have their credit reported to the bureaus. All right, so these guys, they deal in ultra-risky loans to people who can't get a loan somewhere else. And this story, maybe not directly related, but this story, only a couple of days old. Capital One exits floor plan lending business. The banking giant decided to exit floor plan lending on March 29th, but will stay in the auto finance business. Floor plan lending is this practice in the auto industry where a bank will make a large loan to an auto dealer. The dealer uses that loan to go out and buy cars for inventory to sell, and then those cars act as collateral against the loan. Well, a lot of banks are exiting the floor plan lending business. Right? We've seen this since the banking crisis last month, since all those small banks went on defense and were worried about failure. They have stopped lending, especially to riskier borrowers. All right? So who's the first one to fail? The riskiest borrowers. They're the first ones that the bank stopped lending to. So this is absolutely related to the failure of Silicon Valley Bank, to the seizure of Signature Bank and the shutdown of Silvergate Bank. All these smaller banks that are struggling right now, they're not loaning to people like U.S. Auto Sales because they don't want to have those dirty debts on their books. And this is causing these companies to fail. So that's 50 car dealerships around the country that are going to go out of business. That's a lot of salesmen. That's a lot of administrative staff. That's a lot of people who are not going to be getting paid anymore. This is how banks going on defense can cause problems throughout the economy. And this is going to spread from here. It starts in the riskiest areas first. It goes from there. Now, elsewhere in the economy, we had this one today. Brookfield defaults on a $161 million debt for office buildings. Now, you may be looking down at the calendar and looking at the date on this video saying, Jack, you already talked about this. I did. That was a totally different Brookfield defaulting on $100-some-odd million tower and office buildings. This is another story about this. Properties are located mostly in Washington, D.C. region. Brookfield has also had issues with properties in Los Angeles. Brookfield Corp funds have defaulted on a $161.4 million mortgage for a dozen office buildings, mostly around D.C., as rising vacancies hit property values. The loan was transferred to a special servicer who is working with the borrower to execute a pre-negotiation agreement and to determine the path forward, according to a filing on the commercial mortgage-backed security. So here we go. Some landlords are defaulting on debt as borrowing costs surge and the prospects of filling up office towers wanes given the rise in remote and hybrid work. Those trends have weighed on values, with price on office properties falling about 25% in the past year, according to Green Street. And that's 25% that they have fallen so far. They're still falling, folks. Brookfield, a major office owner, previously defaulted on debt tied to two Los Angeles buildings, the Gas Company Tower and the 777 Tower. Landlords, including Columbia Property Trust, owned by PIMCO, also defaulted on office debt recently. Now, I love these statements because they always make these kind of statements. We've always focused on quality, so 95% of what we own are trophy and Class A buildings that continue to see strong demand globally and benefit from the flight to quality, Brookfield spokesperson Kerry McHugh said in an emailed statement. While the pandemic has posed challenges to traditional office in some parts of the U.S. market, this represents a very small percentage of our portfolio. Well, this is the second very small percentage of their portfolio that they have defaulted on. They said almost the exact same thing a month ago when they defaulted on another very small percentage of their portfolio. So how many very small percentages of their portfolio can they default on until we're not talking about a very small percentage anymore? Now we're talking about a couple of small percentages. So this is another warning sign, folks. These borrowers, they can't fill these buildings. And there was where was it down here? Among the dozen buildings in the Brookfield property portfolio, occupancy rates averaged 52% in 2022. These buildings are half empty. Oh, sorry. Yeah, there you go. Permabear. Total pessimist. These buildings are half full. There you go. Now I'm not a permabear anymore. These buildings are only half full, down from 79% in 2018 when the debt was underwritten, according to the report. Monthly payments on the mortgage's floating rate debt jumped to $880,000 in April from just over $300,000 a year earlier as the Federal Reserve raised rates. And folks, they don't get to the really juicy part until the last sentence of this article. And this right now, my God, does this one sentence here just so beautifully illustrate the problem in commercial real estate. I'm going to blow it up. I'm going to make it real big so everybody can see. Pay attention to the numbers and the timelines here. Monthly payment on the mortgage's floating rate debt, important detail right there, adjustable rate. It jumped to about $880,000 in April from just over $300,000 a year earlier. The same building, the same loan, the payment goes from $300,000 to $880,000 in a year. And that's as this building is half empty. There is no way to make this building commercially viable at these pricing levels with these interest rates. And a couple of things here. Number one, oh my God, for the love of God, never let a realtor talk you into an adjustable rate mortgage. This is what happens. Your payment can triple and it's out of your control. The Fed decides we want to put everybody out of work and raise rates the fastest rate in history. This happens. What would happen to you right now if your mortgage payment were to triple? That would break almost anybody. Nobody can afford that. Well, that's what happened to Brookfield with this property. That's what's happening all over the commercial real estate sector right now. So right there, that sentence just beautifully illustrates the scope and the scale of the problem going on in commercial real estate right now. And this is Brookfield's second appearance on this channel in as many months for defaulting on some kind of a major CMBS or commercial real estate loan. Watch out for this, folks. This is going to be a big deal. All right. Elsewhere going on in the market, the big story today, Goldman Sachs stumbles while Bank of America surged in the first quarter. The two financial giants posted diverging results in the first quarter as turmoil roiled banking and markets. Profits and revenues at Bank of America during the first quarter, profits rose and revenue rose at Bank of America during the first quarter while falling at Goldman Sachs. Don't want to spend too much time on this. Goldman Sachs is an investment bank. They are dependent on how hot the market is for things like mergers, for things like IPOs. And right now, that's not doing so well. So Goldman posted a lousy quarter. Bank of America is more of a retail bank. All right. They do more consumer loans. They do more credit cards, things like that. So Bank of America is benefiting from the higher interest rates right now while not raising the interest rates that they're paying, at least not yet. These big banks are starting to have to raise their payouts on their savings accounts because they're losing customers. So that's the trend going on right now. But also keep in mind, while everybody is on CNBC talking about how great the bank earnings have been, keep in mind these banks are sitting on hundreds of billions of dollars of unrealized losses in their bond portfolios and hundreds of billions of dollars more unrealized losses in their commercial real estate portfolios that they are not accurately marking on their balance sheets. These things have gone way down in value since these banks bought them, and the banks are still listing them on their books at what they claim they can sell them for, which obviously they can't. See also Brookfield's default on their commercial real estate. And they're also doing this moving things from in accounting from assets for sale to held to maturity, which basically allows the banks to claim that these bonds and these treasuries on their balance sheet are worth more than they really are. All right, so the banks, basically this is creative accounting, making the bank earnings look great while auto dealers are going under and while commercial real estate is going under. All right, so who could have seen this coming, right? That's what everybody's going to say a few months from now. Who could have seen this coming? Elsewhere, we also got some pretty good earnings today from Johnson & Johnson, although right now J&J stock is down about 2.4%. We were talking about Goldman a minute ago. Goldman stock is down about 2.75%. And Bank of America was actually doing all right, and they're still up about only 0.5%. All right, so that's what's going on today in markets. Let me make sure I didn't miss anybody in here. I did not. So I just want to say thank you very much, everybody, for your time, for watching. Thank you to my Patreon supporters for everything you guys do for the channel. I will be scheduling our Zoom call for tomorrow, later today. So looking forward to talking to you guys tomorrow. Hi, Mom. Hi, Dad. I love you guys. And until next time, live small and dream big.